Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's October 3rd. It's a Tuesday. Can you believe it's the fourth quarter, folks? The fourth quarter of 2023. Feels like yesterday. It was the end of 2022 and the market was finally starting to rally. Well, the market, as we all know, had a great first 6 months of the year. One of the greatest first 6 months that we've ever had. It's been a little choppy since then. But what we're going to talk about today is the housing market. What is your view in a housing market? I'd say 9 out of 10 people I ask are bearish. I might have to prove you wrong. All that and more coming up right now on Making Money. Do you own one of America's 7 most dangerous stocks? These 7 stocks have been on a tear this year, driving about 75% of all the gains the S&P 500 has seen in the first half of 2023, and leaving the other 493 in the dust. But here's what most folks don't know. Owning even one of these stocks could be a dangerous mistake. That's because what's around the corner for the stock market could catch you off guard. It's a distinct pattern that happens roughly every 10 to 12 years. And each time, it opens a rare window in the stock market where investors stand to create or lose huge amounts of wealth. Right now, it's on the verge of happening again. We put everything you need to know, including the names of these 7 stocks, in a new report we'd like to send you today for free. Get the facts yourself. Go to 7stocksreport.com to get your free copy. You can get the full list of the 7 most dangerous stocks and prepare for what's coming. Again, that's 7stocksreport.com for a free copy of our new report. Again, this is Matt McCall. Thanks for joining me. It is the 3rd of October, 2023. It is a Tuesday. And as I mentioned, the first Tuesday here, the fourth quarter. And we had our Q3 wrap up, our look ahead to the rest of the year last week, looking into the markets. We didn't really touch on housing much. And, I'll be honest with you, I'm not a housing expert. I'm one of the few people that has not made money every time he's bought a home. I've lost money sometimes in the last 20 years buying and selling homes with some bad timing due to jobs and moving and personal life and you name it. That being said, from an investment standpoint, I can analyze the numbers of the housing market. I can tell you what the stocks that are related to the housing market are doing. And we can then come to a conclusion that housing bubble? No, it's not, folks. And I'm going to go through the argument for that. And then go through my argument that says we're not in a housing bubble. If anything, this may be a great time to be invested some kind of along the same lines as the housing market. I'm not saying you run out and buy a home. Again, everything's different depending on where you live, your mortgage rates, your situation. I'm not saying that. I'm saying there's money to be made in the fact that we have inventory so low right now in this country that building has to continue. We need homes. And again, we're going to get into a bunch of charts here in a minute, but just big picture. I have friends that are realtors. I have family members. I have a brother-in-law who is a realtor. His parents, his father and his uncle have been in real estate for 60 years. So it's been in his blood forever. So I have ties to people in the real estate business. And obviously, I've owned homes throughout the country. I own homes and land outside of this country, as many of you know, in Nicaragua. So I'm part of the housing market as well. And I gotta tell you, a lot of times, just like stock investors do, and I fall into this category, people who are in real estate are always pushing housing. Buy now, buy now. It's always a great time to buy. It's a great price. I'll tell you, I'm a long-term investor in stocks, and stocks have outperformed real estate, regardless of what people will tell you. If you take the gains with dividends and everything over long-term, S&P has done better in real estate. Real estate's had its big years. You hear the big gains from time to time. It's not consistent though, so it's different. That being said, anytime I bought a home in the United States, I bought a home because I needed a damn roof over my head. But realtors will always tell you it's a great time to buy. Tell you that don't worry about mortgage rates. But obviously, we've had mortgage rates go to decade highs. We had affordability fall to decade lows. But at the same time, inventory is low. So let's start looking into numbers. That's the only way we can really break this down. First number we're going to take a look at is just like it's a Case-Shiller Composite 20 Home Price Index. This looks at 20 largest metropolitan areas, and it looks at the year-over-year price increase or decrease of the average home in these 20 metropolitan areas. You can see for the first time here in the last couple of months, it's gone negative. If we went back to early mid 2022, we had gains up around 20% year over year at home prices. And it's been positive going all the way back the last 10 years until just recently, even during COVID. Actually, even more so during COVID because people started, moving out of the cities, and there was this boom of this anti-urban movement, and that sent a lot of rural areas prices through the roof. Areas like where I grew up in Pennsylvania in the burbs that didn't really see home prices go up more than very low single digits every year. If anything, suddenly boom because it was in close proximity to New York City and close proximity to Philadelphia. And people want to get the hell out of the city because all the crazy mandates that these left-leaning cities were putting on people during the COVID lockdown. So you saw that, and then we've come back down to earth. And people are saying, housing bubble, housing crash. Folks, we're only down 1.2% year over year home prices. 1.2%. That's a crash. You're missing something. We're not going up as fast as we are. But again, look at this chart. From 2020 through early mid 2022, we went from yearly gains of low mid single digits to high teens, close to 20%. That is not sustainable. If it is, we would go into a major bubble. We're just down now to kind of flatlining and down a little bit year over year. That does not constitute a bubble to me at all. And why is that happening? Well, this is probably the best chart to look at here. This is the 30-year mortgage rate going back to 1970, even before I was born. So, obviously I wasn't in the housing market in the early 80s when the average 30-year mortgage was in the high teens, again, close to 17, 18%. I'm sure many people watching maybe didn't have the greatest credit, maybe locked in above 20%. And just think about that. That's what people are paying on credit cards today. And, we've been coming straight down kind of since then, a couple of little bounces up, but really since the early 80s, so you're looking at 40 years of continually falling mortgage rates. And we spiked up in the last year and a half, up to 7.18% most recently. And again, depending where you get the numbers from, sometimes it says 7.2, 7.15, 7.3, generally around 7.2%. And again, highest level in well over a decade. And that's going to drive some people away. And that's going to keep people from going out and whether it's buying their first home, whether it's upgrading to a larger home, moving to a more desirable neighborhood, it keeps people away from that because they can't afford the same amount of home they could afford when mortgage rates were at 3%. Obviously, it's more than doubled from where they are. And there's this whole thing I'm going to talk about in a minute. It's called locked in your home. And we'll get into that. But, people are locked in their mortgage. It means they're locked in their loan. And there's some studies out there, and we'll talk about that in a minute. But two other really important charts I want to show to you before we talk about people that are locked in. This is the U.S. Fixed Housing Affordability Index. The lower it is, it means at least affordable. So you can see back in the early 2010s up to about 2013, homes were very affordable. That's because we had a bit of the housing bubble, obviously, 06, 07, 08, which drove prices down, which made homes affordable for a few years. Ever since COVID, it's gone the other way because home prices have shot up. So as home prices went up, affordability went down. As mortgage rates went up, home affordability went down. Now down to the lowest level we've seen since the mid 80s. Again, we're going back, 40 or so years, folks. So I get it. It's not a great time to ride out and buy homes. But I'm going to tell you in this next chart, and these are all in a specific order, in this next chart as to why we are not in a housing bubble. This is a U.S. existing home inventory. Look at this. We have been declining since about 2007, 2008. Again, that was a bubble. The bubble happened when the home inventory was close to 3.8 million units. We're now at 1.1, and we have more people looking for homes than we did then. Think about that. You had 3.8 million, give or take, homes in inventory. Now we have 1.1, but there's more people looking now. You top out at a bubble when supply is greater than demand, because when supply is greater than demand, it's simple economics. prices must fall. We have supply now, as I just showed you, near multi-decade lows at levels we really have never seen, at least for decades. And again, we have people out there looking for homes. The younger generation, the family formation that they're going through right now, you move from apartments to homes. It's not the American dream we used to have in the past with a picket fence and green grass and all that crap, but people want to move to a home, start having a family. Can't live in that little one-bedroom apartment in the Upper West Side anymore. You got to expand. So you're seeing people move out of metropolitan areas, stay close, and we still work there, but a little out to get a little yard, that type of stuff. So the demand is there, even with mortgage rates at a decade high, even with affordability at multi-decade lows. The reason you will not see a housing crash for home prices is because inventory is near historic lows with a large number of people ready to get into homes. And if and when mortgage rates do come down a little bit, you're going to see a mass flood of people running to buy homes. I think they realize 3%'s a pipe dream at this point. But if it goes from 7.2 to, let's say, 6 or 5.8, probably below 6 is really going to attract a ton of people. It's a bit of a magic number. I have no scientific backup to that, but in my mind, 5.9 sounds a lot better than 6. Talking to some realtors recently, and there's a lot of incentives out there right now too. Trying to get people out there to buy. And again, I think you're going to see very quickly when mortgage rates fall, and that's going to be really dependent on the Fed. The Fed came out recently, a couple of weeks ago, and said, obviously they paused interest rates, but they said they might have one more interest rate hike of 25 basis points this year, which I think is a horrific decision. I'm not going to get into that now. I think the Fed has really just screwed the pooch, as they say. I think they've lost, and I've given them benefit of doubt for way too long. Another 25 basis points does absolutely nothing for the economy, does nothing for the market, does nothing for inflation. It's a complete egotistical move on Jerome Powell and his cronies' part. But neither here nor there. When it does start coming down, mortgage rates will come down and lead to this kind of big move that I'm talking about. One more chart here. Again, I want to show you before I can talk about locked-in homes. And this doesn't really show much in this chart, but just keep in mind what I'm trying to get across here. And this shows the number of realtors since 1980. It's starting to roll over here on the right-hand side. And if you see it roll over like that, that means these realtors are kind of giving up. And I got a statistic that says the average annualized realtor commissions in January of 2021 hit a high of $84,355. By April of this year, it fell to $56,632. So again, that was kind of the high, that bubble that we saw of all the realtors. Now they're coming down. If this was still a bubble that was bursting, you'd have realtors hitting highs. They don't get out till way after. They got out after this post-COVID thing, I think, and a lot of people probably went back to work and aren't realtors anymore. But yeah, I just another sign, folks, that I don't see that we're in this bubblicious territory. Now, this whole concept that I mentioned a minute ago, and there's a paper out there right now, and it's a pretty interesting paper. It's called Mortgage Lock-In, Mobility and Labor Reallocation. It's from two professors. I think one was from Chicago, maybe one from Penn. I can't remember. It's two women. But I scanned it to get some stats out of it. And they said over 90% of homeowners with mortgages are locked in under 6%. And that actually was from a different study. But locked in under 6%. 80% are under 5% mortgage, locked in. And about 25% are below 3%. Think about that. Below 3%. Imagine how low that is. But of course, as most humans do, when it's at 2.9, they say, no, I'm waiting for 2.8, maybe 2.7. Then it's at 3.2, I will go back down below 3. Then it's at 4, I'll go back down below 4. And you end up missing out. I see it all the time in the stock market. Instead of just saying, you know what, this is a great price for the stock, you try to get too cute and try to wait for the pullback and you end up missing the whole damn thing. I think a lot of that happened for a lot of people who didn't lock in and had the opportunity to lock in at a very low interest rate. But in this study by the two professors, they said for every 1 percentage point increase in mortgage rates, which they've gone from about 3 to 7.2. So that's 4 percentage points. Moving rates go down by 9%. So 4 times 9 is 36%. So basically they're saying, based on the study, it's like a 20-year study of mortgage rates and housing prices and people moving, et cetera, that for every time mortgage rates go up 1%, there's a 9% decrease in movement. So it's about a 36% decrease. So people, as they talk about, are locked in. And to really move right now, you need to, if you say move to a new job and that you have to move, you need to have a salary increase about 50% to make up for the new mortgage you're locking in if you're locked in a low mortgage. And it's just not happening right now. You're just not seeing that unless you move to a very different demographic location where things are much cheaper. Maybe, but do you want to do that? Probably not. So I've talked about this before on the show. People are ultimately locked into their homes because you're locked in at 3.2%, let's say. And now you're going to want to get a new mortgage at 7.2%. Let's think about this logically. Say you have a $400,000 home you bought 2 years ago. It's worth $440 now. So you're fine. You're doing well. You're not underwater. You don't have to move by any means. But you're locked in at 3.2%. And you would say, well, you know what? I kind of want to move to a different town. I could probably get a house for the same price, let's say. But your mortgage is going to go up probably by about 40% or so with a higher mortgage rate. And likely, if you're moving to a nicer, more desirable home, it's probably going to cost you quite a bit more. So you take in the fact that your mortgage is going to be higher because you're borrowing more money. Interest rates can be much higher, so it's going to increase the interest that you're paying. Suddenly, you're paying 40, 50% more monthly, and people can't afford that. So they can't afford to move is what it comes down to. They're truly locked into their homes. Will that change at some point? Yes, it will change. But I don't see it changing anytime soon, which again goes back to inventory, because if people aren't moving, the existing home inventory is going to remain low, which will keep prices high. Yes, there's more home builders building, but we're still nowhere near where we need to be. And we'll talk about some opportunities in home builders in a minute. But the bottom line here is, folks, inventory is going to remain low because people are locked in their homes. When you're locked in your home, you can't move, but it's not a housing bubble. We're not seeing prices come down dramatically because of low inventory. The other thing people forget to mention when they equate this to 06, 07, 08 is a lot of people then were underwater. And what I mean by that is they owed more on their home through their mortgage because they took mortgages out or the home prices fell. They owed more on their home than the home was worth. So if they were to pay off their or sell their home, they'd have to come to the table with money to get out of their home. To sell their home, they'd have to put money down. That forced tons of people into foreclosures and situations of people walking away, taking a bankruptcy, whatever it might be. That's a different situation because home prices have gone up, down 1.2% year over year. We're not seeing that situation. And again, I don't see home prices come down dramatically because of inventory. So the bottom line is, it's not 07, 08, 09. It's a completely different situation. So when you read that and you see headlines, ignore that. Ignore that article. It's just not true. I just told you the facts. It's not true. So now let's take a look at some investments. Obviously, that we're here to educate you. Hopefully, just educate you on the housing market. So when the next time the person tells you we're in a housing bubble, you can prove them wrong. We also want to have some fun. So hopefully, having some fun, and then of course some making money ideas. And here we are with some of those. So as I mentioned, we need to build more homes. So obviously, you look to home builders. So I looked at two ETFs, and these are two of the big home building ETFs. One's the iShares U.S. Home Construction ETF, symbol ITB. The other one's the Spiders S&P Home Builders ETF, symbol XHB. And I pulled up a chart here of the last 3 years, how they perform versus the S&P 500. You can see here both the ETFs up around 50% or so, beating the index, the S&P 500, by over 10%. So beating it by about 25% on the upside. Great outperformance of 25% over 3 years, which is really nice. So it's done very well. ITB and XHB, even though they sound almost exactly the same, one's home construction ETF, the one's home builders ETF, they're actually very different. And that's why you always have to look at an ETF and what it holds, what its thesis is of what it's trying to do versus just a name, because a name can be deceiving. When I look at ITB, that is a home construction ETF. Look at the top four stocks. The top four stocks, all home builders: D.R. Horton, Lennar, NVR, and Pulte Homes. They make up 41% of the entire ETF. So essentially, you better like those four home builders because you're putting a lot of money into it by buying that ETF. And again, I'm not telling you to buy either of these ETFs. I'm not an ETF guy. Typically, we like to build our own with stocks in certain trends. This is one trend. XHB, which is the home builders ETF, which you would think would be the home builders. Really, you take a look at the top four stocks in ETF, only make up 16%, so it's more diversified, which I do like that. But the top four are Carlisle, Williams-Sonoma, Johnson Controls, and Trane, which not one of those four are home builders. There's some home builders in the top 10, but none of those four are home builders. If you take a look just over the last 12 months, ITB, which is majority home builders, has actually performed XHB by about 13%, 49 to 36%. So it's actually done pretty damn well over that time frame. But again, I see a lot of great opportunity, folks, when it comes to the home builders, and they have pulled back in the last few weeks. And I think that does really open up an opportunity, especially going to Q4 and next year. If mortgage rates start coming down a bit, if they anticipate the Fed stopping, which I think even if they go 25 more basis points this year, there's no way in hell they can do anything more next year. They'll likely pause for several months and then probably see a rate decrease at some point mid to third quarter next year, which again means mortgage rates top out. If they're not already, they're very close to topping out, in my opinion. So keep that in mind that once they start coming down, these home builders should really take off at the same time. There's also, we can take a look at some other areas. If you're locked in your home, you can't move, but you love your home. You want to make it feel homey. You can't afford to move to that extra bedroom, whatever it might be, the extra office. Why not put an addition on? Why not redo the basement? Why not redo the kitchens and the bathrooms? So I think you really need to look at home improvement stores. I think there's a lot of opportunity there. Obviously, the two big ones we all know, Lowe's and Home Depot. There's another one called Floor and Decor, which is symbol FND, a little bit smaller than the others. But to me, that locked in will lead to remodeling, a boom. And not only that, a lot of these companies do supplies for new home builders as well, which again, I think we're going to see with inventory at 1.1 million, near decade lows. We need more building of homes. So these companies should do well when it comes to that as well. And then there's the materials companies. You think about that. When it comes to materials companies, everything from roofing to the doors to HVAC, heating, HVAC systems, windows, lumber, even copper, folks. There's a lot of copper in homes and buildings. So all those are other ways that you could play this housing boom. And there's a lot of small mid-cap stocks that have done extremely well that I think are great plays when it comes to that. Then what about, furnishing these brand new homes? Furniture stores, maybe something like a Williams-Sonoma that does furniture, your kitchen appliances, etc. So there's a lot of ways to play this trend. And that's like for us, what we'll do here at the McCall Report is we'll put together a basket of whatever we call the theme, whether it be the housing boom of the 2020s, is a pretty catchy name in my opinion. And we build our own ETF, whether it be 3 stocks, 5 stocks, 7 stocks, somewhere in the middle there, maybe up to 8 stocks. And whatever you allocate towards that trend, say it's $7,000. We have 7 stocks. You put $1,000 in each. It's just like putting $7,000 into an ETF, but you're buying your own ETF. You're not paying management fees. You're building your own. There's no fees of trade. You can get in and out whenever you want. And you're building that based off what you think are the best plays and truly diversified, whether it be home builders, probably some home improvement stores, probably a bunch of material companies, and maybe furniture or something like that, appliances that we can put in. But then you're truly diversified playing that trend. So for some reason, the consumer slows down, doesn't buy furniture, you're still probably good because the building's still going on, and vice versa. Different things can happen. So that's the best way to play this trend, folks. But I got to tell you, I just think the whole housing bubble headlines and discussion, please debate it and let people know these facts, these numbers, these statistics, and find them and print them out or whatever that is, pull them up in your phone and save the pictures, because I really believe that people need to hear the truth, and we're here to uncover that truth of what's really going on Wall Street. So I hope you enjoyed the show, folks, and I hope you have a happy rest of your week, and here's to a happy fourth quarter, last 3 months of the year, holiday season. Nothing like going out and smiling, shaking somebody's hand, giving a hug, spreading the joy a little bit early before the holiday season comes. So again, thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.